Hi, everyone. Larry Berman here, and here's what's on my radar this week. Well, March is off to a bang up start, but we don't think that anything we saw this week is going to lead to a material change in what the next few months is going to be about. We have, pretty significant geopolitical risks that are building. Want to have a quick look at a study that came across my desk this week before we dig into the chart room. Survey is results of a citizen poll that was done in Russia. How they do it, I have no idea. The question was around the support for special military operations. And so what you can see overall here is that just under 80% of Russian citizens definitely or mostly support what Putin is doing in Ukraine. If you break it down by age cohorts, what's obvious is the boomer class, the older people with more of a legacy of what the pre-wall was all about, is much more in favor of the next generation or younger generations that don't have the same ideology, if you will. And so there's this big divergence developing in Russia. But it does suggest that there's no end in sight for what's going on there. And recently we've heard backing of support from China in terms of possibly giving some military support to Russia. We think this trend towards less globalization is another inflationary factor that the world has not had to deal with since the wall came down. 1990 wall comes down, world is getting closer together. China's making moves to become international distributor of products and building out, and a lot of that is changing dramatically and rapidly. I think in part behind some of the job demand and pressures we are seeing from this less globalization, where tremendous amount of part-time labor demand in the United States, for example, over the last year, is where all the job creation has come. And of course, this week, as we dig into our chart room, we'll get a sense of this. So when we look at the economic calendar this week, we see some pretty important economic data points coming out, but none more important than, of course, the employment situation report that's going to be out on Friday. And we can see from the data here that the expectation is still for a pretty robust 200K addition to non-farm payrolls. And this is above the 500 we saw last month. Now, again, over the past year, the vast majority of jobs have been second jobs, part-time jobs. And so the quality of full-time employment isn't as strong as the labor market suggests. We also get the JOLTS job opening labor turnover survey, and more eyes are on that lately. So it's going to be an interesting week. But earlier in the week, we get the FOMC, we get Chair Powell in what was formerly known as the Humphrey Hawkins in his semi-annual testimony to first the Senate Banking Committee and then the House Financial Services Committee. So, Powell released a statement on Friday basically saying we're committed to our 2% inflation target. And then, next week, he's going to defend that in front of both houses of Congress. So, we're going to see questions around how much are you going to go? This is painful for consumers, my constituents, yada, yada, yada. And we're going to see how Powell responds to that. My sense is that his feedback to politicians is going to tilt on the dovish side. And that might have been around why the markets this week at least saw a pretty significant degree of short covering. So how did that all play out? Well, when we dig into the S&P 500 here, we can see we did not get to very deep oversold readings, relative or compared to the relative strength index to what we saw in September and October. We got this big divergence here in the September and October lows, and that set up a very deep oversold buy where we didn't get the same this time around. But the catalyst here was basically 3 days in the last 7, where we came down to the 200-day average, bounced, got above the 50, failed, got back to the 200, bounced, and now today broke above the 50, which caused some technical buying to come in. And we don't see anything in the economic data or anything in terms of what anybody said to change the fact that this is purely a technically driven move and not anything that would be a change in the fundamental outlook towards a harder landing or earnings impact, etc. When we look at some of our pro-eyes indicators, market breadth, percentage of stocks above or below the 50-day average, so in this case above. And so again, we've been playing with that 50, 200-day average over the past week. We saw the overall S&P come down below it. We saw about half the stocks drop below it. Again, a little bit oversold, nowhere near what we saw at the levels last summer. So to say this is a robust breakaway rally, to me, is very naive in terms of looking at it. And the other thing we like to look at in terms of our pro-eyes for short-term indicators, in addition to market breadth, is, of course, what are we getting from the behavior of volatility? And so this blue line down here is the current month VIX futures contract, and the red line is the 4th month VIX futures contract. And so the relationship of what volatility is pricing now compared to what volatility is pricing, 1 quarter from now is pretty important in terms of measuring the depth of the oversold condition. And so this blue line here takes the relationship of the 1 and the 4th month VIX futures contract, puts it into a statistic called the Z-score, which helps us measure mean deviation, standard deviations away from the mean. And again, what we saw in terms of the sell-offs over the past year, so when we get to a 2 standard deviation reading, we get very extreme. And we got very extreme readings early in the year around the Russian invasion of Ukraine. We got similar 2 standard deviation moves at the June and the May lows. Much less intense in terms of the panic that we would see in terms of volatility. And of course, very recently, almost no standard deviation away from the long-term relationship between those averages. And you could see at the low this week that we were basically at neutral relative to the last year. So there's no panic and fear whatsoever in the market now. And this is a very, very modest technical rally here that I don't think is sustainable. Now, based on what Powell tells us this week, the rally could bounce a little bit more, or he could beat the hawkish drum and say, hey, no, we don't want risk assets and financial conditions to ease here. We're not of that mindset yet, and try to push markets lower. And so how does that play out? Well, we'll see this week. I'm not sure. I expected Powell to be Powell. That would be a hawkish Powell. Powell to be more hawkish in his press conference at the FOMC in early February, and then the follow-up interview where he used the word disinflation several times, and yet every Fed speaker following that had to walk back his more dovish comments. So we'll see if he gets it. We'll see if he's more of a hawk than a dove at this point. The last time we heard from Powell, he was dovish. That could be behind some of the short covering we've seen in the markets this week. But again, no evidence whatsoever that this is risk on and we break out to the upside here. Would be very, very surprised if that happens. So when we look at our bull and bear picks of the week, what are we looking for on the bull side? Well, I did a deeper dive this week into duration with the US 10-year and the US 30-year nudging above 4%. You know, we looked at that and we've commented recently where, at least for now, we think that sell-off in long bonds is a good buying opportunity. And we saw that as we were getting close to and testing 4%, that, you know, that support held and we got a little bit of a rally in the long bond. And so that rally can continue a little bit. I would look to sell into that. We were buyers below 100 this week on the TLT, but would look to trim that again on any meaningful rally, another % or two higher here. We don't think it's sustainable. Now, if long bonds do rally here and rally significant to the point where we get back below 3.5% or TLT starts to get above 110, that to me would be the market pricing in a recession. And folks, that's not going to be bullish for equities next time it happens. So caution on equities. Start to get interesting into the bond part of your portfolio in terms of extending duration. But let's see what Powell has to say this week before we make any of those moves. Have a great week, everyone.